Hello and welcome. My name's Alex Wenham. I'm the digital asset product and strategy lead at Bloomberg, joined by Oscara Tempaki, who is the head of growth and investor education at Token Terminal, here to discuss from raw to refined the evolution of on-chain data. Thank you very much for joining us all. So, Oscar, maybe we can just kick off with kind of like a broad but kind of basic question that I think is incredibly important in crypto. Crypto is not a homogeneous asset class, right? There's lots and lots of assets. They do lots and lots of different things. So at Bloomberg, we cover the top 50 crypto assets. We define that by the assets that have custody support, that trade on big and large reputable venues, that are large in market cap and liquid. So this is how we kind of look at the world. But from a token terminal perspective, to get us kicked off, where do you draw the line on the thousands of assets that are out there? How do you pick your universe to start doing the great work that you do?
Yeah, that's a great question, and it sure isn't a homogeneous asset class in any way. There's a lot going on, and excited to cut through some of that noise during this session here. But I think a good place to start there is to really give a little bit of context as to why it is such a multifaceted asset class. And when you think of crypto, a synonymous term to that is pretty often you hear the term Web3 used. And taking it from the start, you had Web 1, which is a very static version of the internet, no user activity, no user generated content. And what enabled the era of Web 2 that can be broadly characterized as the emergence of social media. That was thanks to dynamic content through HTML, JavaScript, etc. But how we then got to Web 3 from that was really the introduction of a new data layer onto the internet. This data layer consisting of blockchains, or this data layer being blockchains that consist of global accounting databases that are pretty much credibly neutral, smart contracts that automate business logic, and then user-owned and controlled assets and data. So where Web 1 was kind of read-only, you had Web 2, which was read and write, and then came Web 3, which is this crypto era that is read, write, and own, where every single interaction on this data layer is stored on these public ledgers. And why this is really relevant, and I wanted to go through it as a preface here, is that one way to think of Web 3 or crypto is the ownership layer of the internet, right? And as it is this ownership layer, everything gets financialized. You have value capture mechanisms built into the base level infrastructure, so blockchains. You have internet native companies running on this infrastructure. And then you also have the financialization of everything else related to the internet. So that's why you see so much content in the form of like NFTs. You have meme coin frenzies and everything else, like lots of vaporware equivalent to spam sites in Web 2. That's what makes it such a diverse asset class, really. So we have this new data layer on the internet. But to directly answer your question on how we navigate it at Token Terminal, our hypothesis is that the world's most valuable services will be owned and operated directly on the internet. And broadly speaking, we see two types of layers of crypto applications. You have the blockchains, which are these global open source application platforms, so the rails for the rest of crypto. And then you have the applications built on top of the blockchains, which are businesses that could run on either just one or several blockchains at a time. And both of these are conceptually similar to traditional marketplace companies that are just built directly onto the internet. So that's what we focus on, these internet native companies that can be valued based on fundamental metrics such as user activity, revenue, or earnings. And we really do our best to showcase that crypto assets are in no way purely speculative, but rather productive assets that should be valued based on the cash flows that they produce. And maybe to dive a bit deeper into that then, in terms of how we pick specific projects within this cohort of fundamentally sound protocols and businesses, we somewhat follow two frameworks there as well. Firstly, where do we see the most activity today in terms of both economic traction and user network effects via like fees generated, daily active users, the growth of total value locked, so forth. And then a more forward-looking way is to look at which ecosystems we think will have the most activity in like the mid to long term, so that we have the data available for investors to analyze if and when these ecosystems start gaining traction. Because in general, there's so much high signal information available for investors to analyze on chain. We, of course, aim to have all of that data for the most promising projects, most innovative ones, well-funded ones, and especially fundamentally sound ones listed on our platform for investors to assess. So that's kind of what we really focus on, filtering out the noise, helping investors realize that there's really good companies being built on top of blockchain rails, and there's a lot of high signal information available.
Awesome. I like that analogy. It kind of makes you think of like a utility telecommunications company that's providing the internet, and then of course all the companies that are building services on top of that, social media, banking, payments, all the rest. So maybe if we pivot slightly, if we talked a little bit about like how you think about the crypto ecosystem. So when we kind of surveyed our clients about like what they would like to see from Bloomberg when it came to crypto, of course there was asset coverage, there was pricing, reliable pricing, and other metrics. But one thing that popped up a lot was this kind of blanket term of kind of on-chain data. And this was something that like 85% of our customers wanted to see. One of the challenges when we started to investigate what does on-chain data look like is depending on the customer, they would have a very, very different kind of opinion of what that would entail. So ultimately at Bloomberg, the way that we've kind of approached this is almost like a kind of pyramid effect, right? At the very bottom of on-chain data, you really have like raw unadulterated data that comes directly from the blockchain. So if it's Bitcoin, it could be the meme pool. If it's Ethereum, it could be staking rates. It could also be the tokenomics of that asset. As you go up kind of one of the levels, you start to get to kind of wallet-based information. So flows to exchanges, whale alert, whale flows, etc. And at the very kind of top of the pyramid, you're really kind of connecting the dots between the raw data, what's happening in wallets, with kind of some connections to get some data-driven insights, which I would say Token Terminal is there. But to get from layer 1 to layer 3, there's a lot of assumptions that you need to make. So maybe if we start to kind of get into on-chain data, and I might take your analogy again in terms of how you describe these companies, given that we're talking about an infrastructure company or we're talking about a service provider, there's going to be certain metrics that are relevant to one that aren't relevant to another. So how about you perhaps frame a little bit of some of the sectors that you maybe cover within the analysis that you do, and maybe talk a little bit about the on-chain data that you have within kind of one sector that might be comparable and others that might not be comparable, but more specific to that sector.
Yeah, you're 100% spot on with that. And this really naturally builds on my previous kind of point there as well, that the bucket of internet native companies is in itself very diverse as well, as you have both the blockchains, base level infrastructure, and the rest of the whole crypto tech stack, and then the applications built on top of it. So it's pretty important to distinguish between these. So what we do is categorize projects by market sector. And we currently have 16 market sectors live on Token Terminal. These include layer 1 blockchains, layer 2 blockchains, you have lending protocols, decentralized exchanges, stablecoin issuers, gaming protocols, social media, so like consumer social protocols, asset management, and much more. And why this market sector split is so important is that it helps benchmark competing projects against each other more accurately. Because as you alluded to, there are different metrics within different market sectors. And then within market sectors, there are also very different approaches to solving certain problems, and different business models. Similarly to, as in TradFi, within a market sector, you have very different business models, but you want to still standardize the metrics so there's comparables possible. So what we do is we take a really standardized approach to decoding the business logic of different smart contracts and mapping that logic to individual transactions to create comparable financial metrics. So we are basically the accounting layer of the crypto market. Like you kind of mentioned, we're at the top connecting the dots, making sure that things are comparable on their own. But to kind of build on the way that we think of crypto via 2 layers, blockchains and applications on top of them, in terms of metrics, blockchains are networks or application platforms. So the detailed metric coverage there is inspired by like AWS or Google Cloud type of businesses. And then for the applications built on top of this, they are companies. So their metric coverage is inspired by the relevant market sector that the company operates in, right? Modeling what you'd see in the traditional world, for example, in sectors like financial services, consumer social, and so on. And because we have like point of sales data streaming in real time, there's a lot that we can showcase on our charts. So what we can do for both of these, like the blockchains and applications, is pretty much showcase like earnings call style data at any frequency, be it hourly, daily, weekly, or anything else really. But if it could make sense, I'd be happy to like dive into 2 more specific examples of protocols within 2 different market sectors to see how we kind of map it out.
Yeah, I think that'll be great. And I think one point that you said there that I think will be massively interesting to customers is you're talking about almost, well, block by block, depending on the blockchain, every 10 minutes, let's say, you know, uh, ratios on performances of companies, right? This is not waiting for a quarterly earnings release in a typical framework. This is like block by block, metrics and updates on profitability and other versions of these companies. So I think that's a completely different way of thinking about things in traditional finance. But yeah, it'd be great to get into a couple of specific examples, within two different sectors.
Yeah, I'll get to that. And it definitely is. It's a complete paradigm shift in terms of the accuracy and granularity of like stakeholder reporting that we've never seen before. So it understandably as well, it takes a bit of time to grasp and really understand the power of it. That, okay, you have point of sales data streaming in real time. What can I actually do with this? But to go through these two examples, I'll pick from the layer one blockchain market sector because that's one with the most interest and attention right now. Let's take Ethereum. And as a pretty simple example, let's take Compound from the lending market sector. Compound is one of the first DeFi projects launched in 2017. It's an on-chain bank that connects lenders and borrowers. But how we break down the metrics is for every project, in order to make them standardized, we start from defining the revenue generating activity, be it a blockchain or an application. So like the gross merchandise volume or volume. For Ethereum, it's the total transaction volume. Same for all blockchains. And for a lending protocol like Compound, it would be the loan origination volume. That's the starting point when you start applying the business logic to raw on-chain data. Then what we do, as these are pretty much similar to marketplace companies, you map out what a user pays for the service. So fees generated. On Ethereum, that's transaction fees paid. For Compound, it's the interest fees and loan origination fees. Then you'd map out all the stakeholders, see who the supply side is, and define the supply side fees or the cost of revenue from the protocol's perspective. So what percentage of the total fees paid goes to these service providers as they are marketplaces? And I'm really nailing that in because that's like the easiest analogy to think of all of these projects from. And in Ethereum's case, the supply side is the validators who keep the network up and running and secure. And then in Compound's case, it's the lenders who provide collateral for loans. What we then do once we map those things out is we define revenue. So the share of fees that accrue to or is captured by a protocol and its token holders. Ethereum works in a way that a portion of every transaction fee is burned, so removed from circulation. The burned portion of fees paid by users is revenue for Ethereum because the burn mechanism is conceptually similar to a stock buyback, which accrues value to shareholders. So in that way, Ethereum burns accrue value to the holders of Ether. So it's revenue. For Compound, as it's a business on top of this infrastructure layer, it's a bit more straightforward. You have the Compound DAO that captures something around 20% of the total interest fees paid by borrowers. And that cut goes directly to the DAO's treasury, which is controlled by the protocol's token holders, who can in theory decide whatever they want to do with it. So while the specifics of how we get to a metric like GMV, fees, or revenue can differ by market sector, they are as comparable as possible within sectors and across different ones. And if we look at like the blockchain market sector, layer one on its own, you have very different technical approaches. Just walk through Ethereum, but then you have something like Solana, which is absolutely booming right now. Adoption rates are going through the roof. These two projects have very different technical approaches and solutions to the same problem. But when you approach mapping out their business logic and metrics from the perspective of defining revenue generating activity, mapping out the stakeholders, seeing how value flows throughout the economy on that blockchain, you get very comparable metrics. And then it's just, of course, up to an investor or analyst to look at the suite of standardized metrics and decide which ones are most relevant to use to assess a specific project, taking into account its purpose, maturity, current level of adoption, and so forth. And those are like the most basic ones, defining a business model. But as of today, we have 46 metrics live on Token Terminal that include both financial and alternative data points. Some of those popular ones include daily active users, core developers, token incentives, cost of revenue, and then valuation multiples like price to fees and price to sales ratios, which are really great proxies for doing like relative analysis between different projects within a market sector. And what I'll just finally say is you asked like what some of the most popular metrics are within a market sector. Outside of the pure business logic and assessing business models, you have like crypto specific metrics that, especially on the infrastructure layer, are really important to look at. And if you take something like blockchains, it'll be transactions per second, block times. You have average transaction fees paid. Those are like really important to assess when comparing projects. Or with liquid staking protocols, it could be the amount of assets staked. Stablecoin protocols, you're going to want to look at the outstanding supply for stablecoins and transfer volume of that specific stablecoin. But there's a lot to dive into. As I mentioned, it's like point of sales data. So really deep level of granularity. And our goal is to provide investors with as much information as possible for each market sector and every project that we list.
I think this is what this kind of analysis is all about. When you do relative value analysis, whether it be in equities or fixed income, you're really looking for outliers that stick out and then try to understand why they stick out. So, if I think about what you just mentioned with Compound, a lot of DAOs, what you get from holding the DAO token isn't necessarily consistent across DAOs, right? So Uniswap at the moment is talking a little bit more about if you are a token holder, then that might give you a share of revenue. That does come with, okay, now security or not, let's just leave that legal debate aside, but not all DAOs necessarily give you a slice of revenue. So do you provide or help clients to understand if you're kind of analyzing, let's say, Compound versus MakerDAO, right? And would you kind of break down the comparative value of those metrics, but also give the context? So one might give you a share of revenue, one might not, right? Which is obviously two different kind of ownership structures of that same kind of token that you might be analyzing.
Yes, definitely. That's a really good point. And there are very many like qualitative factors that need to be assessed when looking into crypto protocols, in addition to just the pure quantitative data available through like Token Terminal. Because if you look at just one data point on its own, be that, for example, revenue, for Uniswap, that's zero. So, but then if you look at something like MakerDAO or Compound, the revenues are very high. So just purely comparing based on that metric doesn't make any sense. So you actually need to understand what's going on in the governance forums and take into account the stage and maturity of the protocol to understand why they might not be monetizing yet and what the potential revenue could be if they decided to start monetizing, which you can map out from metrics like fees, which are the total fees paid by users, and you can apply like a market standard fee rate that other protocols in the decentralized exchange market might be using, and kind of do analysis with the help of that. But we do make it really as clear as possible that what the current state of a project is and how a metric should be looked at, what the methodology is, how we've arrived to it. And we also do add notes in case there is a situation or a specific reason for not having revenue activated or something like that.
Nice. So maybe I'm just going back to the way that you were kind of describing the way you look at these as businesses, right? So the revenue that you get for, let's call it, issuing block space or renting or selling block space versus how much you need to pay to validators to validate those blocks, right? So pure kind of revenue versus cost basis. Can we maybe, I know you kind of touched on it between Ethereum and Solana. And look, maybe Ethereum and Solana are not the right ways to do this, right? Ethereum is blocked up. Of course, there's some upgrades that are coming through with layer 2 kind of availability, but if a blockchain is blocked up and fees are really, really high, but there's nowhere else to go on those applications, there might not be a fair comparison to, say, Solana, which is a new technology. So pick your other blockchain of choice, but like, how would you kind of compare Solana, let's say, and another layer 1 blockchain, and maybe go a little bit deeper into the kind of analytics that you would do that you would think about to kind of compare those two layer 1 blockchains?
That's a great question. So one thing is just looking at the high level metrics for an individual blockchain. But because these are like application development platforms, that the goal is to get entrepreneurs to deploy smart contracts, so incorporate businesses onto these platforms. What you want to do analysis that really gives you a better picture of the state of that network is dive into what businesses are being launched on these platforms and how the network effects are taking off. And how you can do that is, because everything is open, you can just go into view the trending contracts, so the trending business contracts on a specific blockchain, and then do comparative analysis between, say, the top projects on Solana and between Ethereum. Or you can do the analysis by market sector. Like, one good place where when an ecosystem starts bootstrapping liquidity, what usually happens is that decentralized exchange volumes start taking off, and there are specific applications in a network that then deploy to a new network and kind of kickstart this growth flywheel. So what an investor can do in these more like nascent protocols, and which you can really see in real time with Solana right now, is there are so many entrepreneurs deploying new contracts and starting new businesses on Solana, which are gaining a lot of user traction. So how to go deeper from just the individual metrics on a blockchain is to really start analyzing the activity on that network and doing comparative analysis between the companies being launched on these systems. Because to make another analogy to a normal world from an entrepreneur's perspective, when they think of where to launch a company in the modern world, you think of which jurisdiction do you launch it in, which has the best like legal environment for you to deploy that company or incorporate that company. For in a blockchain's perspective, you think of where you want to deploy your smart contracts, which gives you the best environment to grow. And so there's entrepreneurs doing that analysis, but investors as well can gain really good insights from digging into the contracts.
So we talked a lot about analogies here, right? So would you kind of be like the comparison that you're saying there is you've got like, Solana is Amazon Web Cloud Services, and blockchain B is Microsoft Azure, right? You're talking about like how many customers are on board into each of those kind of ecosystem. What do those customers do? What kind of sectors are they in? That's the kind of traditional finance equivalent of that kind of metaphor or example that you gave.
Exactly, yes. And the total value of the applications deployed on a network is kind of relevant to analyze when trying to assess the value of the actual underlying network itself.
I mean, what I think is amazing about what you do is the way that you translate kind of raw on-chain data that like really differs a lot from platform to platform to platform into kind of a comparable metric, but one that kind of traditional finance understand from equity analysis. So, is this really a like for like? Like what kind of I don't really give away the secret sauce here, but like what kind of assumptions do you need to make to kind of get to that level of equivalence?
Yeah, so mainly they are like to like, but I'm gonna add a disclaimer there that you need to keep in mind that for some of these projects, there are no existing benchmarks from traditional finance that you could compare them to. Take Ethereum, for example, there is no traditional finance asset that you could benchmark one-to-one against that. So there are differences, and that's why it's important to have the methodologies really clearly stated so investors can analyze what parts differ from like the existing standardized ones in TradFi and comparing them to crypto. But in general, they are marketplace companies. So when you drive the metrics from starting from the revenue generating activity, it's pretty standardized. So that's where you get to a very like to like sort of comparison, because Ethereum and Solana are selling block space. Simple as that. Amazon Web Services or Google Cloud, they're selling cloud servers. So it's basically one-to-one in terms of what they're selling. And then applications like Compound and Uniswap, they're providing either lending or exchange services. And the revenue that they generate from that is very one-to-one. But then, and the business logic there is very straightforward and comparable. But as blockchains are permissionless platforms and smart contracts can be coded in all kinds of different ways, it's sometimes really painful, let's put it that way, to standardize these metrics. But we do get it done. And thankfully, we're seeing that the business logic in these smart contracts is increasingly converging to somewhat of an industry standard format that is more comparable with how traditional companies report their metrics. So it's getting easier. Right now, there's a bit of heavy lifting that needs to be done, but these entrepreneurs are understanding that they need to kind of structure these smart contracts in a way that makes it easier because investors want to know what's going on.
Awesome. Makes sense. So maybe if we like pivot the last kind of 7 minutes here. So obviously Bloomberg serves traditional clients primarily. It'd be great to kind of understand some of the examples or use cases that you're seeing for this data in kind of traditional financial firms. Obviously from your role as kind of educating investors here, and it'd be great to get your perspective on that.
Yeah, definitely. And this is a really interesting one. And especially recently, we've been seeing much more like diverse use cases come in as there's been so much attention coming through the Bitcoin ETFs, which is amazing. And I'd say we're approaching a point where people are starting to understand that the longer tail of these crypto assets are internet native companies that can be valued based on fundamentals. The misconception of it just being about currencies or speculative assets is slowly starting to go away. So that's great. And the investors that do get it today, on-chain data and the metrics that we provide are being used for research. That's like use case number one, to better understand the underlying business logic of these protocols, assess adoption, network effects, benchmark the performance against both non-crypto companies, but also existing TradFi kind of counterparts to see what level of disruption crypto is actually really bringing to like the financial industry. You can also track in real time what kind of real world assets are being tokenized, which is a big topic, and so forth. But outside of just research, these data streams can also be used to power valuation models. We're seeing a lot of that, even entire investment underwriting engines, because the data is streaming in real time. You have more advanced portfolio monitoring and so on. So this is like the paradigm shift that you alluded to earlier. It's pretty neat. And when you think of it, typically access to financial and especially transaction level data of a startup, of companies that are in terms of maturity comparable to startups, most of them, has been unheard of. And now that is available to everyone from the day that a startup launches on chain. So from an investor's and analyst perspective, it completely changes the game because all of this high signal information is available from day one. That has never been there for non-insiders beforehand. But I want to maybe walk through a very timely use case, a specific one that we've been seeing more of now, because it's not just relevant to crypto native companies, because we have existing traditional companies expanding into this space and launching on-chain business lines as we speak. And the pace of this development is only increasing. So I think this is a pretty cool one. For example, if we look at Coinbase, which, while operating in the crypto market, is mainly a traditional fintech company. However, they have on-chain business lines that include both staking services and their own layer 2 blockchain called Base. And if you're an analyst or investor thinking of how to analyze Coinbase, how to value Coinbase, it's pretty tough to understand the nuances of what's going on under the hood from their quarterly reports, where, for example, like layer 2 blockchain Base is grouped under the other category on the financial statement. That's it. So how on-chain data is being used today is to gain an edge on the market, because you can open up Base's dashboard on Token Terminal, examine its key metrics on, say, a daily granularity, benchmark its performance against competing layer 2 blockchains, and then use this data to support modeling out revenue and growth projections for Coinbase without the need to wait for like vague quarterly reports, because this is like an innovation arm within that company. You can track it in real time and see how it's getting traction. And to put some numbers behind that example, right now, like the Base blockchain is generating around $500,000 in transaction fee revenue every single day, with about 1.2 million monthly active users, where, for reference, Coinbase, the centralized exchange, has about 7 to 8 million monthly active users right now. And then if you look at layer 2 blockchain market in general, the leading players there, like Arbitrum and OP Mainnet, they're sitting at something like $20 billion fully diluted valuations. And you have the real-time data of Coinbase's competitor to that streaming in real time that you can analyze. And that's just the layer 2, right? Then they have the staking service, where they have a bunch of ETH staked. They're the second largest staking provider at the moment. And you can dig into what's going on in the staking market as well. You have the market leader Lido, currently valued at about 3.5 billion fully diluted market cap or something like that. And Coinbase's on-chain business lines could be argued to be worth billions of dollars. And the data is already there, but not in the quarterly reports. So that's like a really timely use case. And of course, Coinbase is a pioneer on this front, but we're seeing more and more companies starting from fintech build on chain. Robinhood just announced they're partnering with the layer 2 blockchain Arbitrum to offer on-chain swaps for their users. Then you have PayPal with PUSD, enabling users to pay with crypto. That's a stablecoin. And developers can use that stablecoin as a payment layer to build new services and products on public blockchains. You can assess the adoption of this payment layer in real time. And then you have Reddit. It's about to IPO. They've done a lot of on-chain experimentation. Circle, the second largest stablecoin issuer in the market, they're about to IPO as well. You can assess all of their stuff on chain, which is pretty cool, and a lot more examples. And we really heavily believe that this trend is just going to keep picking up pace as these internet native companies and their on-chain business lines are pretty much infinitely scalable when you think of it from the perspective of its data layer on the internet. The internet is infinitely scalable. It's global from day one, accessible by everyone, thanks to its permissionless environment, and there's more high signal information available for investors to analyze. So this trend isn't going anywhere, but as of today, there's a clear edge that can be gained by investors by digging into the on-chain data of these companies. So I'd say it's really exciting stuff, Alex. We're able to track in real time the innovation and adoption of this new permissionless and decentralized internet native economy.
I think it's pretty like it's maybe worthwhile just repeating there, right? So like an equity analyst is covering Coinbase. If you're typically covering a traditional financial firm, of course, you're meeting people in the firm, you're tracking the industry, you've got some kind of, thoughts of how that industry is going and some themes that are affecting that industry. But what you're saying here is if you're an analyst covering Coinbase and you believe that their on-chain business is 20% of the overall revenue, at least it was last quarter, you can monitor that in real time and see if that's doubling or if that's increasing in between quarterly reporting periods to kind of get an insight as to things moving really in advance to reporting. I repeat that because I think it's worthwhile just clarifying because it's so crazy from how we think about things in traditional finance. But look, Ascari, this has been a fascinating conversation. I think we've done a pretty good job of not going down too many of the rabbit holes that are in on-chain data, and I think it probably is worthwhile, depending on the feedback on this seminar, to even think about doing some further educational insights for our customers. But look, at this juncture, I really want to thank you for taking the time to kind of explain on-chain data, how Token Terminal takes and applies on-chain data to analysis. It's been a really interesting discussion. I've enjoyed it thoroughly. So thank you very much for your time.
Thank you so much, Alex. Really enjoyed this. Let's do it again.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars